This week's news has been nothing short of dramatic, with key global events shaping the markets. Let's start with one of the biggest stories, Tesla. Elon Musk rolled up to the stage at the highly anticipated Robotaxi event in true Tesla fashion, unveiling two new futuristic vehicles, the Cybercab and Robobus. These self-driving vehicles are designed to change the way we see the future of transportation, with production slated before 2027. But despite the flashy announcements, investors weren't impressed. Tesla's stock tumbled over 8% following the event, as the lack of concrete business plans left many with more questions than answers. This drop in Tesla hit the broader tech sector hard, with ripple effects across the Nasdaq and NDX. Now, let's turn to the Middle East. The region continues to be a focal point for geopolitical tensions. Just this week, the U.S. Treasury announced a new wave of sanctions targeting Iran's petroleum and petrochemical sectors. This came after Iran's second direct attack on Israel this year, and it's clear that tensions are escalating. These sanctions are designed to cut off critical revenue streams for Iran's destabilizing activities in the region. While oil prices remain surprisingly stable after these sanctions, the risks of supply disruptions are real, and the market is keeping a close eye on further developments. And in response to the mounting uncertainty, we're seeing a surge in safe haven assets, particularly gold. Prices for gold spiked to nearly $2,650 per ounce this week, not far from record highs. Investors are flocking to gold as a hedge against both inflation and geopolitical instability, with fears of a wider conflict in the Middle East keeping demand high. Gold has now extended its rally, snapping a 6-day losing streak, and it's clear that market participants are ready to pile in as uncertainty grows. Meanwhile, Bitcoin is also catching some of that safe haven attention. With major institutional investors like BlackRock reporting higher than expected inflows, Bitcoin saw gains of over 3% this week. It's becoming clear that cryptocurrencies are gaining traction as an alternative hedge, especially in times of global instability. Now, let's dive into the broader market. The Federal Reserve has kicked off its rate-cutting cycle after years of holding rates steady. The most recent CPI and PPI data came in hotter than expected, raising concerns about lingering inflation, but that hasn't stopped the market from pushing higher. The S&P 500 and Dow Jones hit new all-time highs this week, driven by strong earnings from major U.S. banks like JPMorgan Chase, Wells Fargo, and BlackRock. Despite some mixed reactions to inflation data, the broader market is clearly benefiting from strong corporate performance. And finally, we've seen a robust rally in small caps, with the Russell 2000 and SPDR S&P Regional Banking ETF both posting solid gains. This came after strong third-quarter earnings reports from regional banks, which have helped lift sentiment in this segment of the market. So with all this in mind, let's jump into the charts to see how these developments are shaping up across key indices, commodities, and individual stocks. Let's start with the S&P 500 and SPY, which continue to rally, setting new all-time highs. The financial sector has been leading the charge thanks to the strong earnings we saw from U.S. banks. With JP Morgan, Wells Fargo, and others exceeding expectations, the S&P surged past 5,800 points this week. But what's driving this momentum? It's the combination of strong earnings and the Fed's dovish policy that's fueling the broad market rally. Looking at the SPY daily chart, the technicals are telling a bullish story. We've broken above previous all-time highs at 564.36 day, which is now acting as support. The RSI is sitting at 60, giving us plenty of room to move higher before hitting overbought levels. The PPO shows bullish momentum with strong separation, and we're above all key moving averages, the 100-day, the 200-day, and shorter-term ones. This indicates that we're well-positioned for a continued run, and from a longer-term perspective, we see very few headwinds. But if we zoom into the shorter-term picture, things aren't quite as clear. On the SPX hourly chart, we're seeing signs of bearish divergence. While price continues to make higher highs, the RSI and PPO are making lower lows, signaling a potential pullback. It's possible we'll see a retracement back into mid-September's range, especially as the market digests the upcoming U.S. election results and ongoing inflation concerns. It's a reminder that while the larger timeframes look bullish, caution is needed on the shorter timeframes, especially as we approach key event risks. Next, let's shift to the tech-heavy Nasdaq and QQQ. While the broader market is being lifted by financials, tech stocks are facing a slightly different narrative. Following Tesla's disappointing Robotaxi event, where key details were left out, Tesla's stock plunged 8%, dragging down the Nasdaq along with it. This drop has added pressure to the QQQ, though the technicals remain bullish overall. On the QQQ daily chart, we see a strong consolidation above support at 486. Like SPY, we're above all key moving averages, and the RSI sits at 60 with bullish PPO separation. There's clear resistance at the previous all-time high of 503, but for now, the chart suggests we have room to test that level. However, The NDX daily chart offers a more cautious view. We're sitting above support at 19,949, but there's been some selling pressure after each session close this week, with daily candles showing larger upper wicks. The NDX hourly chart paints us a slightly different picture, showing bullish conditions with PPO separation and RSI around 50. The Nasdaq futures haven't seen the same bearish divergence that SPX has, which means the tech sector could still push higher despite the weakness in Tesla and other tech names. Finally, let's talk about small caps, represented by the IWM. While the large cap indices have been grabbing the headlines, small caps are quietly staging a comeback. The rally we saw in the Russell 2000 this week, driven by strong earnings from regional banks, is one to watch closely. Banks like Bank of New York Mellon and Wells Fargo have boosted sentiment, and we saw SPDR S&P Regional Banking ETF, KR, rise 2.7% in response. This has had a knock-on effect on small caps, pushing IWM up 1.7%. On the IWM daily chart, we had a very bullish Friday, breaking above key support at 212 and approaching resistance at 230. We're above all major moving averages, and Friday's price action took us decisively above the shorter-term moving averages, setting the stage for a potential move higher. The PPO is on the verge of a bullish cross, and the RSI is sitting at 60, giving us plenty of room for upward movement. But here's where things get interesting. This bullish small cap performance conflicts with the SPX hourly bearish divergence we mentioned earlier. Small caps tend to be more sensitive to shifts in the economy, and if the broader market starts to correct, small caps may face headwinds. But for now, the chart suggests that IWM has the potential to push higher, especially with the positive momentum from the financial sector. Turning our attention to Europe, we've seen a lot of volatility in global markets, and the European indices are no exception. While the S&P 500 and Dow have been setting new records, Europe's major indices have been responding to a mix of local and global factors, from inflation concerns to the ongoing geopolitical uncertainty in the Middle East. The FTSE has been range-bound for most of the week, with price action going nowhere fast. We've seen RSI and PPO flatlining, and the price continues to trade within a narrow range. This isn't surprising given the broader uncertainty around the UK economy, which has been grappling with persistent inflation and slower growth compared to its European neighbors. Moving over to France, the CAC 40 has been in a more volatile position. The CAC has been consolidating just below its 100-day and 200-day moving averages, but there's more potential here compared to the FTSE. Recent price action has bounced off the summer's daily divergence, and while we're seeing some bearish momentum in the PPO, it looks like we're on the verge of a bullish cross. We're looking at minor resistance at 76.02 and more significant levels at 77.50 and 79.22, with RSI sitting at 50, indicating plenty of room to move higher. The CKC's technical picture suggests that the French market could be gearing up for a rally if it can break through these moving averages and key resistance levels. And finally, we get to the DAX, which has been one of the most bullish European indices. Germany's economy is often seen as a bellwether for Europe, and right now, the DAX is sitting above all-time highs at 18,909. Like the US markets, the DAX is benefiting from a combination of strong earnings and resilience in the German economy, despite global headwinds. The DAX daily chart shows us a very bullish outlook. We're above all the major moving averages, and while the PPO has flatlined, it's on the verge of a bullish cross. The RSI is at 60, so we still have room to push higher before becoming overbought. The DAX is well positioned to continue its rally, and if we see a continuation of strong earnings from key German sectors, particularly in industrials and tech, the index could hit new highs in the coming weeks. What's particularly interesting about the DAX is how it's tied to the global growth outlook. Germany, as a major exporter, is sensitive to shifts in global demand, and with U.S. markets hitting record highs and China starting to show signs of recovery, the DAX could benefit from this global momentum. Additionally, if inflation continues to moderate and central banks remain dovish, the DAX could continue its bullish trend. Commodities and cryptocurrencies have been in the spotlight this week, driven by a mix of geopolitical tensions, inflation fears, and shifting investor sentiment. With the Middle East conflict escalating and sanctions on Iran's oil sector coming into effect, we're seeing safe haven assets like gold rise sharply, while oil prices are holding steady despite the risks. Cryptocurrencies like Bitcoin are also catching the attention of institutional investors who are looking for alternatives as uncertainty rises globally. Let's dive into the charts and see how these markets are reacting. Starting with gold, the precious metal has had a stellar week, rising to nearly $2,650 per ounce, just shy of its all-time high. The combination of inflationary pressures and geopolitical tensions has driven investors into gold as a safe haven asset. The ongoing sanctions on Iran's oil sector and the potential for further escalation in the Middle East are only adding fuel to the fire. Looking at the gold daily chart, we're sitting well above support at $2,630, and the technicals point to continued strength. The RSI is sitting at 60, which gives us room to run before we hit overbought conditions. The PPO is currently bearish, but it's starting to flatten out, and we could see a bullish cross early next week. Importantly, gold is well above its 100-day and 200-day moving averages, signaling strong upward momentum. However, we need to be cautious. While the fundamentals are very supportive for gold, the charts suggest we could see some consolidation in the coming weeks. Gold has rallied sharply in response to geopolitical risk, and it's possible we could see a pause as the market digests these developments. But if tensions in the Middle East escalate further, we could easily see gold explode higher, breaking through resistance and heading towards all-time highs. Silver is following a similar path to gold, but with slightly less bullish momentum. Silver is currently trading around $31, and we're seeing some resistance at $32.81. Like gold, silver has benefited from the flight to safe haven assets, but the price action has been more subdued. On the silver daily chart, we're above the 100-day and 200-day moving averages, and RSI is sitting around 50, suggesting there's room to move higher. The PPO is still in bearish territory, but we're starting to see a slight upward curl, indicating that a bullish cross could be coming soon if price action remains positive. Silver's outlook is also influenced by its industrial uses, which makes it more sensitive to global economic conditions. While silver has followed gold's trend as a safe haven asset, it also benefits from any signs of economic recovery, especially as industrial demand for silver picks up. But with the ongoing uncertainty, silver is likely to remain under the influence of broader market risk sentiment. Now let's shift our focus to crude oil, which is at the center of the geopolitical storm. With U.S. sanctions on Iran targeting its petroleum sector, you'd expect oil prices to surge. But surprisingly, oil has remained relatively stable, with WTI crude hovering around $75 per barrel. This stability suggests that for now, the market doesn't expect a significant disruption in oil supplies, but the risks are clearly there. On the crude oil daily chart, we're sitting just below the 100-day moving average, which is acting as resistance. The next key level to watch is $80, with more resistance around 85. RSI is at 60, indicating that there's room for oil to move higher. And the PPO is showing wide bullish separation, signaling strong upward momentum. If tensions in the Middle East escalate further, or if we see any physical disruption in oil supplies, we could see prices break through these resistance levels very quickly. The real story here is the risk of supply disruptions. The U.S. sanctions are aimed at cutting off Iran's revenue streams. But if Iran retaliates by targeting oil infrastructure in the region, or if Israel escalates its response, we could see a much more significant impact on oil prices. For now, the market is taking a wait-and-see approach, but traders should be prepared for potential volatility. And finally, let's talk about Bitcoin. While Bitcoin is often viewed as a risk asset, we've seen an increasing narrative around its role as digital gold, especially in times of geopolitical uncertainty. This week, Bitcoin posted a solid gain of over 3%, largely due to strong institutional inflows, particularly from BlackRock, which reported higher than expected fund inflows into its crypto products. On the Bitcoin daily chart, we're seeing a period of consolidation, with price hovering around key moving averages. Both the PPO and RSI have been flatlining, which suggests we're in a bit of a holding pattern. However, with geopolitical risks rising and more institutions getting involved, Bitcoin could be primed for a breakout. If the current consolidation breaks to the upside, we could see Bitcoin move quickly to the key narrative around Bitcoin right now is its growing role as a hedge against uncertainty, much like gold. Institutional investors are increasingly viewing Bitcoin as a diversification tool in their portfolios. And with BlackRock's strong earnings report highlighting increased inflows, it's clear that institutional interest in crypto is rising. If tensions continue to escalate globally, Bitcoin's narrative as a safe haven asset could strengthen, driving prices higher. So, to recap, we're seeing strong bullish momentum in gold and silver, driven by both inflation fears and geopolitical risks. Crude oil remains stable for now, but there's potential for volatility if the situation in the Middle East escalates. Bitcoin is consolidating, but shows promise as institutional interest grows. With global uncertainty on the rise, these markets will continue to be a critical space for investors seeking safe haven assets or opportunities to capitalize on geopolitical events. Let's take a look at our current swing trades, which have been benefiting from the broader market trends and specific sector news. While the major indices have been hitting new highs, individual stocks are offering solid opportunities for traders who can navigate these setups. Here's an update on the key swing trades we're tracking. Starting with Micron Technology, MU, we're seeing strong technicals on the chart. MU is testing key resistance at $108, which aligns with the 100-day moving average, while support sits just below at $99.80. With RSI at 60 and PPO showing wide bullish separation, we expect more upside potential if we can break through this resistance zone. Micron has been a solid performer, driven by demand in the semiconductor space, and as the global chip shortage continues to ease, MU is well positioned for further gains. If we see a breakout, the next resistance levels are around $130 and $137. Google's has also been showing strength. We're currently sitting just above support at $160, with the 200-day moving average offering a key test for the stock. While the PPO is starting to show a bearish cross, the overall price structure remains bullish. Google's recent push into AI and cloud services has kept it on the radar for long-term investors, and we're watching for a potential breakout toward $174 to $178. If the broader tech sector continues to rally, this swing trade could see more upside. Next up is Moderna MRNA. This trade has been more volatile, with the price recently pulling back below $65. However, we're seeing significant bullish divergence, with price making lower lows while PPO and RSI are making higher highs. If this divergence plays out, we could see a reactionary bounce to around 88.40s. Moderna has faced some pressure post-earnings, but the chart is still constructive. Traders who stayed in or re-entered the trade could be well positioned for a recovery move in the coming days. Tesla has been making headlines after its recent Robotaxi event, but the stock has been under pressure, falling over 8% after the lack of clear business plans. Despite this, TSLA is sitting above the 200-day moving average at $209, with stronger support down at $180. Tesla's RSI is nearing oversold territory, and we're seeing the PPO turning bearish, but this could present a buying opportunity. If we see a rebound, resistance levels at $270 and $295 are key areas to watch for potential profit taking. UPS has been showing solid technicals lately, with price breaking above the 100-day moving average and now testing resistance at $134. We have additional resistance at $141 and $155, but the PPO just made a bullish cross, suggesting that more upside could be ahead. With RSI at 60 and bullish momentum building, UPS looks well positioned to continue its run, especially if we get above these resistance levels. This trade has been following a strong uptrend, and the technical picture remains supportive. Finally, Albemarle has been a standout swing trade, up 20% from our initial entry. We've now hit the downtrend line, and traders should consider booking partial profits as we approach resistance around $111 at the 200-day moving average. With PPO still showing bullish separation, ALB looks poised for more upside, but it's always smart to manage risk by locking in some gains here. Now let's switch gears to our longer-term investments. While swing trades offer short to mid-term opportunities, these stocks are more about holding for the bigger picture, taking advantage of market cycles and capturing long-term growth. Starting with Amazon AMZN, which has been consolidating recently after a strong run earlier this year. We're currently trading in a tight range, with the RSI and PPO flatlining, showing less predictive value in the short term. But here's why Amazon remains a cornerstone of our long-term portfolio. It's a giant in both e-commerce and cloud computing, and its AWS division continues to dominate the cloud infrastructure market. Despite the current consolidation, AMZN remains a safe bet for long-term investors, especially with the broader tech sector continuing to show strength. As the company expands into AI and further strengthens its logistics network, we expect Amazon to remain a major player in the coming years. Next up is Microsoft MSFT, another tech giant that offers long-term stability. MSFT has pulled back recently, offering a potential buying opportunity around the 100-day and 200-day moving averages. The PPO is on the verge of a bullish cross, and the RSI is sitting at 50, suggesting there's room to move up. Why is Microsoft a safe long-term investment? Beyond its cloud computing dominance with Azure, Microsoft has a strong foothold in AI, enterprise software, and gaming through its Xbox division. The company's diversified revenue streams make it less vulnerable to sector-specific downturns, which is why it remains a favorite for long-term investors. Any pullbacks in price should be seen as opportunities to accumulate shares. Pfizer PFE has been mostly consolidating lately, with the chart showing flatlining indicators, so there's not much immediate action here. However, from a long-term perspective, PFE remains a solid healthcare stock. Its strong pipeline of vaccines and therapeutics, along with the continued revenue from its COVID-19 treatments, gives it a stable outlook. With healthcare being a defensive sector, PFE is one of those stocks you can hold through market cycles, benefiting from consistent demand regardless of economic conditions. Intel INTC has been a volatile player lately, but it's still above our entry from a few months ago. The stock is targeting a close of the gap around $29-28, with the 100-day moving average acting as potential resistance. The PPO is bullish, and the RSI is at 60, indicating room for more upside. With Intel receiving $3 billion in government funding to expand semiconductor production and support from the CHIPS Act, the company is positioning itself as a key player in the tech sector's supply chain. This long-term investment remains promising as Intel continues to recover and innovate within the semiconductor space. As we wrap up, let's quickly recap what we've covered today. The markets are being driven by a mix of strong earnings, inflation fears, and escalating geopolitical tensions. The S&P 500 and Nasdaq continue to show bullish momentum with strong support from earnings, while small caps have been lifted by solid results in the banking sector. Commodities like gold and crude oil are benefiting from the uncertainty in the Middle East, while Bitcoin is starting to gain more institutional attention as a digital safe haven asset. Our swing trades, from Micron and Alphabet to Tesla and Albemarle, are showing strong potential for further gains. And our long-term investments in Amazon, Microsoft, and others offer solid growth opportunities in key sectors. Looking ahead, the market will continue to react to Fed policy and the ongoing geopolitical risks, particularly with Iran and Israel. It's critical to stay informed and keep an eye on key levels in the charts, as any changes in these global narratives could create volatility. Make sure to like, subscribe, and hit the notification bell so you don't miss our next update, where we'll continue to break down the market moves and trading opportunities.